Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. And today I wanted to focus on confronting the fears of a new trader of options. I can relate back to the time when I first started learning about options. The thing that kept me up at night was the potential for early assignment. What happens when a contract is assigned early? It seems very spooky. Well, I want to talk through what might lead a contract to be assigned early and what the trader might do about that if it happens to occur to them. So I think it's going to be a great discussion. We are going to be confronting fears and why this might not be such a spooky or such a scary event. But I also want to talk through what might be some of the more mathematically correct way to handle these sorts of events. So a lot to address. Before we get to any of that, though, let me first of all say hello to everybody who's chatting in out there in YouTube. Great to see you, Ricebird and Will, Mighty Mouse, Jim E, Wiley, see ya, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the presentation, but be aware that you're invited to join us in a live discussion. If you would like to be here, this is a Thursday webcast series. It kicks off promptly at 11 Eastern time. Love to have you here in our live stream audience. Also, want to let you know that my very good friend Brent Moore is going to be hanging out in the chats. He's going to be addressing any questions that I can't get to just during the natural flow of the presentation. Experience this discussion. I thought we might be struggling with the audio. I got a little notice here. Let me just double check something. You can hear me now? Okay, perfect. All right, excellent. In any case, Brent and I have been working together for more than 20 years now. Brent really brings a lot of experience to this discussion. Brent's going to be addressing any questions that I can't get to during the flow of the presentation. Thanks for having my back there, Brent. And Brent and I would like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite Schwab presenters there. It's the best place to connect with us in between these live streams. You can find Brent on X at Brent Moore CS. You can find me on X at Cameron May CS. But let's get into this. And of course, as we do, we need to consider the risks associated with trading and investing. This is important information, so please bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so here's what we're going to be talking about today. Let's set an agenda for the day. The first thing that I want to do is go through our existing positions. Now, this webcast, this video, is just the latest in a series of ongoing webcasts relating to long vertical spreads and long diagonal spreads. So we already have some existing positions in an example portfolio, and I think one of those holds an important lesson to be had regarding early assignment. So I'm going to use that as the opportunity to have this discussion about what is a very common fear in the options trading world, and especially for those that are new to this business. So we're going to take a look at our existing positions. We have two that I'll go through quickly. The third, I want to spend more time to explore that topic. But then we're going to go add a new trade to the existing portfolio. And to set the stage for that, we'll take a look at the market, see what's going on there. But that's what we're going to be talking about today. So let's go right to the Thinkorswim platform, start going through our example current trades. So we have, as of this moment, two positions. We have Gilead and we have Google or Alphabet. But we had three when we left off last week. We placed a new trade on BAC, and that thing has disappeared. Well, what has happened? Well, if we go up here on the Thinkorswim desktop platform, go to the account statement page, and we look back over the last 8 days for BAC, we'll see what happened. So last week, we took a trade where we bought a long call vertical spread, bought the $49 call, sold the $50 call for a net debit of 63 cents, and then we put a stop on that at 50% of that investment, so around 32 cents. Well, we saw some volatility over the week, and we were stopped out. So we paid 63 cents for this for this vertical spread, sold it, stopped. The stop was a very quick movement on the 8th, where it triggered the stop, but actually sold at a higher price. So it wasn't a terribly painful stop. We wound up losing 18 cents per share. It was just one contract. So net, it was 18 bucks lost. Yep. We'd have to add in some commissions there. So maybe around $19 total lost, which is kind of in keeping with the theme for last week, which was trading in a smaller account. And I think even a small account can absorb a $19 loss unless that account is absolutely tiny. So that might be, might feel like I'm consoling the trader here, just lost 18 bucks. Oh, it's diminishing. It's not a big deal. Well, I'll tell you what could be a big deal, and that is, let's go see what's going on with BAC right now. So here's when the trade was taken. 49 long call, 50 short call. The stock pulled back, tipped us out right there on the 8th, and immediately started to rally. This can happen. This is why we can't just discuss the pros of or the potential benefits of taking a particular action like adding a stop to a vertical spread. But we also have to talk through the potential cons, the disadvantages. And in this case, what may ultimately happen, what might potentially transpire is that this trade just goes on to behave just as we might have hoped. And as we move toward that October 10th expiration for the original trade, this might have been in position for a maximum gain, in which case we might be turning our $63 investment into $100, making a $37 reward rather than incurring an $18 loss. That's a big deal. So yeah, sometimes some traders just prefer not to enter stops on spreads. There are pros and cons. It's up to the trader to make that decision for themselves. But this sort of is a good illustration of the other side of that coin. So, just out of curiosity, I wonder how much this $63 investment would be worth right now had we not been stopped out. We can go to our trade tab, look at BAC. Let's go out here to the 10th of October. That was the original trade time frame. I'm going to switch this up to a vertical spread right here. Let's switch the spread from single to vertical, and then we can look at our 49.50 strike pair. That looks like that's trading between 65 and 75 cents. So it's worth about 70 cents right now. We sold for 45 cents. My rough math says we left, as of this moment, about 25 cents on the table, or about 50% more money. Wow. Okay. That's a risk of placing a stop. I'm not saying a trader should or should not. I just say that we need to consider both sides. All right. So that's a good lesson from our BAC spread. Let's go back to our current positions, see what's going on with Gilead. I'm not going to spend much time on that because I want to leave the bulk of our time for an alphabet discussion. Let's go to GILD. Well, let me show you what's actually happening here first. Okay. Right now, we own a $95 call that expires on the 17th of June of 2027. That's in 644 days, about 2 years from now. We've also sold a 120 call that expires in 36 days. So really what we'd like to see is for the stock to go up and help out that long call, but stay below 120 through the 17th of October. So as high as it can go while still below 120, really optimally would be 119.99 if we're just going for absolutely best case scenario. Well, right now the stock's at 116.47. So here's what that looks like on a chart. So you can see here's our 120 short call. The stock going up is continuing to help out this long call that we bought back in January. So this is now our diagonal spread that we find ourselves in. But actually with this diagonal spread, there's quite a history to it. We bought the long call months and months ago. We've held on to that. It's done well. And in the meantime, we've also collected some premiums along the way. Some were profitable. Some we took losses on. But this is where we find ourselves right now. I think we're going to leave this one on. Let's see if it can continue to climb, getting closer to that 120 short. It expires out here on the 17th of October. So we'll keep an eye on that. Nothing that I'm going to be doing with that today. So that brings us to our alphabet diagonal spread. So with this, we bought the 180 call for the 16th of January, 2026. Sold the 215 call for the 19th of September 2025. That's 8 days away. So the preference here is for the stock to go up to help out this long call, but to stay below 215 until we get to the 19th of September. Well, it's going up, so that's check for objective number one, but the stock is now blasted up and through that 215 strike. Look at this. As we go to a chart of Alphabet, here's what the stock has done. It has really gone up through our 215 short strike. And this contract is, as of this moment, this would be $23.50 basically in the money. And so I want to talk about what might very well happen to a trader at this point. What we've done here is someone has the right to buy shares from us for 215. We sold a call at that 215 strike. So through September 19th, someone has the right to buy shares from us for 215, which is at a sharp discount from the value of those shares right now. $23.50 below market value, as a matter of fact. So what this does is it really elevates the risk of early assignment. So if the trader does not want to get called, if they don't want someone buying those shares, and we're actually on the hook for 200 shares because we did 2 contracts, the trader might consider maybe just getting out of this contract at the moment, because assignment risk is there. Now, assignment risk is always there, even if a contract hasn't even gone in the money yet. Even out of the money contracts do face the risk of early assignment. It just tends to be a smaller risk, and in lots of scenarios, a much smaller risk. So I wanted to talk about this because we have this luxury with paper money. It's not going to be assigned early. Paper money doesn't assign contracts early. There's nobody out there in real life assigning fake contracts. So it just doesn't happen. But in actual life, if this were a real trade, assignment risk is now elevated. Now, I'm going to make an argument for why even now, that trader, whoever owns this call that we sold, whoever owns the call that we sold, why it's probably not in their mathematical best interests to assign that contract. But with that as a backdrop, I do want to say there are some circumstances that can elevate the risk of early assignment. First of all, one thing that can elevate risk of early assignment is the further this stock goes in the money or above our strike, in the case of a call option, the higher the risk of early assignment. Because that trader now is getting, theoretically, a steeper and steeper discount compared to the market price of the stock. Sia says assignment risk is imminent, I think is what you meant to say in a real account. Imminent is the wrong word, I would say. I get what you're saying there. But even deeply in the money contracts, not necessarily just going to be assigned out of hand, because I'm going to make the case again that usually the math says, and as a matter of fact, in most cases, the math says it's not in the best interest of the owner to do that. There's probably something else they should do. And skipping to the end, they should probably just sell the call to somebody else. But in any case, going deeply in the money can raise the risk of early assignment. I think that kind of makes sense. What else can raise the risk of early assignment? Well, getting closer to expiration. There is a buffer, a theoretical buffer between assignment risk and actual assignment. And it comes down to, and largely, the extrinsic value of the contract, right? Let me go to our trade tab. Now, this is not always going to, it's not like that we can look at a number and we can say, okay, well, I'm still safe. No, there's no safety in this effort regarding assignment. Assignment can happen at any time, even if it mathematically just doesn't make sense. Let's switch this back to single contracts so we can see all the individual strikes. Let's go down to the one that we're talking about, which is the 215 call. And I want to add a new column here. Let's go to our Delta Theta Vega. I'm going to customize our column set, and I'm going to add the extrinsic value of these options here. You might also think of this as the time value of the option. Okay, let's click OK. So we now have this column that says extrinsic. And as we look at that 215 call that we are seeing is way in the money, it right now still has $2 of time value. Now, here's something that I can say about whoever bought this call from us. If they decide to assign their contract, they lose that money. That's gone. There is no retrieval of value from that. That's if they assign the contract. Now, obviously, the motivation to assign the contract is to buy the stock at a discount, but they're getting what does that work out to be? About a 23, almost a $24 discount, but they would be surrendering a $25.50 asset to get that discount. The difference there being the time value. That time value is the buffer. It's not a guarantee. But when we see that time value erode, either by going deeper in the money, if you look at this, as we go deeper in the money, these $200 calls are deeper in the money than 215 calls, that time value is smaller. As we get closer to expiration, the time value decays, it gets smaller. And the smaller this number becomes, the greater the risk of early assignment. So this is a number that some traders might keep an eye on to sort of gauge their relative risk of early assignment. They can never know for sure. Even somebody with this much time value could decide, you know what, I don't care. I'm going to assign the contract, right? So that's a possibility. But yeah, assigning early, we lose this value, or the trader loses that value. Now, there's one other thing that could come in here that can, even as the trader is looking at this, maybe we have our eyes on this, let's say $1.90 in time value, and I think, okay, well, there's still a bit of a buffer here. I don't think it's very likely that my contract is going to get assigned. So I'm going to hang in there and see if the stock will just come down for a while. You know, maybe they're thinking assignment risk is still unlikely. So if we hold on for a few more days, maybe the stock will come down. Let me buy out of this call at a lower price, whatever. Well, what may happen behind the scenes is this. Let's go back to our charts and look down here. If we get too distracted by time value, we can miss dividends. And dividends can motivate early assignment sometimes. Because let's say that the owner of this call that we sold, it gives them the right to buy 100 shares. Well, if they want a dividend that's approaching, they have to assign, well, they don't have to assign, but one thing they could do is assign the contract, buy those shares, and be in position to collect that dividend. They'd have to do that before this dividend date that's appearing on the chart. But this can be sort of a tug of war between, Greg says, Cameron, I believe it's the 19th of September. Am I looking at the wrong one? That's definitely possible. I was still looking at the other one, wasn't I? Let's go to the 19th of September. Ooh, guess what? That's just going to make my point about time. The passage of time is going to diminish the time value of the contract. So 215, it only has 47 cents. Oh, okay. Actually, thank you for calling that out, Greg, because it reinforced the earlier point that I made. And it's actually going to add more weight to this point that I'm about to make. And that is, sometimes when a trader is deciding whether to assign a contract or not, one thing that can push them over the edge and say, yeah, I'm going to go assign this, is if they assign the contract early, as long as they're not giving up too much time value, if it puts them in position to collect a dividend, they might choose to do that. So here's another thing that a trader might look to as they're gauging their relative risk of early assignment, is look to see, is there a dividend being paid before expiration, not being paid, but the ex-dividend date, which appears on the chart here. Is there an ex-dividend date on this stock before expiration? And does that dividend value exceed the time value of the contract? If it does, for some traders, that might push them over the edge. It might cause a few more to assign early. Even with all these circumstances lining up, we still don't know for sure if a contract can be assigned early, because I could even make the case that dividends should be a non-factor, because what happens when a dividend is paid? Great, you bought the shares right before the dividend, but then those share values are adjusted down by the amount of the dividend, and that's kind of a wash. Not everybody sees it that way, but that's how it actually works. So, but in any case, yeah, there are a few factors. Getting closer to expiration, going deeper in the money, and having a dividend before expiration that's, well, and especially if it exceeds the remaining time value in the contract. So, but whatever the reason, okay, Harry says, can you explain assign versus exercise? Yes. It depends on which way we're looking at the contract. If we are the seller, in this case, we sold a 215 call. The buyer has the right to exercise their contract, which assigns the deal to us. So a buyer exercises, the seller is assigned. Okay, that's what that's the difference there. And I have to be careful with my language when I'm talking about both. All right, so, but bottom line is we never know exactly why someone chooses to assign. And even all of this hard work that we just did to try to minimize what we perceive to be our assignment risk, we could still be assigned at any time. So regardless of why a contract is assigned, it can still be a scary event, and it can have a trader's hand paused over that panic button. I want to hit the I didn't want to get assigned. In this trade, let's go back here. Let's skip ahead and say, let's assume that that today the contract was assigned. Oh no. What does that actually mean? Well, we had two short options right here, the 215 calls. Someone had the right to buy 200 shares of stock from us for $215. We don't own any shares of stock. So here's the scary thing that happens. All of a sudden, shares are purchased from us. We have 200 short shares. Now, I'm not going to go deeply into short stock, but just be aware there's unlimited risk on that. If this weren't a covered position, it is. So let me ask you, if this contract is assigned and all of a sudden 200 shares disappear from our account and are replaced by $215 per share, what should the trader do at that point? Or what are some of the considerations that they might think through? That's a big question. Well, the first thing they might do is they have their hand paused over the panic button and slam it down and say, oh, I know what I'll do. I also own two contracts that allow me to buy 200 shares for $180. Great. Awesome. Whew. Okay. I was panicked there. Ooh, I thought someone just bought shares from me for $215. I thought I was going to have to go out and buy those shares for $239. That'd be a $24 per share loss. But instead, I can just buy shares for $180 because I have the right to. That turns this $29 loss. So here's what I'm talking about. If we're required to sell shares to someone else for $215, and if we just went and bought those shares to give them to someone else for $239, that'd be a $24 loss on the shares, right? That would be the buy to cover on a short stock position. $24 loss. But if we exercise, go back to the earlier question, Harry, if we exercise our right to buy shares for $180, that turns this $25 stock loss into a $35 stock gain. Because now we're buying shares at $180 and we've already sold them at $215. That'd be a $35 loss instead of a $24 gain. Obviously, this is what the trader should do, right? That's a $59 net improvement on just buying the shares at market price. Nope, probably not what that trader should do. They can if they want to. But my argument is the math says there's a better way to do this. What's probably a better way to do this? If the trader just wants to be done with the whole thing. Here's the problem. Here's the problem with exercising that 180 call. Yes, it results in a $59 improvement on the exit on the stock price, but in other words, it turns a $24 loss on the stock into a $35 gain on the stock, $59 improvement. But we're surrendering the remaining value. Let's go back here to our activity and positions. We're surrendering the value of that $180 call. How much is it worth right now? The contract is worth 64 bucks. So we are surrendering $64 to create a $59 improvement on the stock trade. Now, by my math, that's a $5 loss. That's not the best mathematical way to handle this if we want to be done with the trade. What would be mathematically the best way to handle this right now to get done with that short position? So we're not just sitting there with 200 shares short, but to squeeze the most juice out of this trade. Best thing to do probably would be to just sell that contract. If we sell this, let's say, I'm going to do some round numbers here. Let's say we're able to sell this 180 call for $64. Well, now we have $64 in our pocket. Now let's go buy 200 shares of Google. If those shares are, and I'm doing some rounding again, $239, look at this. We pay $239. Yep, we're paying full market price minus a few pennies here, just for the example. Paying $239, but we already have $64 from the sale of our option. How much is it costing us net? How much do we have to come up with of our own money to complete this deal, close out the trade? 175 bucks. You answer me this question. Would you rather pay $175 net or come up with $180 to exercise the call? Now, see, you're exploring some other things that we could do. I'm talking about, you're saying maybe we could roll this short. I'm saying no longer a choice because it's already been assigned. Hasn't been. This is just a hypothetical. But I just wanted to talk through mathematically handling this best. Now, I'm only saying that's the best of the two choices that I've outlined because there are other things that could happen. Maybe the trader just says, you know what? All right, I have to sell the shares for $215. I'm just going to buy them back for $239. Just be done with the short stock position. But I'm not going to sell my long call because I think it's going to continue to rise in value. Maybe it's going to be worth more than $64 down the line. That's another way that this might be handled. But if we're just weighing, exercise our long contract or sell our long contract, the math in almost all scenarios says do the latter. Sell the contract, use the proceeds to supplement the cost to purchase the stock on the open market. That's mathematically the best exercise or best exit between those two choices. So I'm going to bottom line this little discussion of early assignment by saying this. If the owner of this 215 short call decides to assign right now, my argument would be that's probably not the mathematically best thing for them to do, but I'm not them. They can do whatever. They may have some other reason they decided to do it this way that might be totally valid. But the math would say that was probably a mistake. So if they made a mistake assigning early, should this trader now make their own mistake just by repeating the first mistake, which is assigning early? Early assignment is usually mathematically a mistake. That's it. That's the bottom line. Anyway, so for now, Greg says, what if you don't have cash? Well, Greg, you do have cash because $215 per share were just paid to you. Yep. And then you also have the value of your long option. So you have $215 plus if you sell that long option, that's $64. You have cash. That's plenty of cash to cover this. Now, anyway, guys, was that helpful? I hope if you need to go back and revisit this math, please do. This is one of those webcasts that's scheduled to be added to our playlist. So if you haven't done this already, make sure that you subscribe to our Trader Talks channel because this is where we house previous webcasts. If you want to go find them, the vast majority are housed right here. You can go to our playlists for Trader Talks Schwab Coaching Webcast. So first thing, go down the lower right-hand corner, click on the subscribe button. It doesn't cost anything. It only takes a moment. Or you can go down below the video screen and click on subscribe there. But this is where we house our playlist for previous webcasts. And you can go find the whole series for this webcast series. We have lots of different webcast series. Mine's found closer to the bottom. If you scroll right on down to the bottom, I think it's the second line up right there. Long verticals and diagonals, so we can see the full playlist right there. R1 says, could you please summarize the conclusion again? Yes. Mathematically, early assignment is usually a mistake. Now, that's not to say I'm not getting into other things, tax considerations, other stuff like that that can complicate the scenario. But usually, if a trader is just trying to wrap up a trade right now, assigning a contract early is not usually the mathematically best way to handle that. Usually it's to, if we own a long option, sell that option, and with those proceeds, use that to apply toward like the purchase of the stock. That would be the scenario in this case. Yeah, that's the bottom line. Okay, but here's where we can find the archives for this webcast series. But let's go back now, and now that I've sort of finished that part of the discussion, I do want to place a new trade in our example paper money portfolio. Before we do that, let's have a look at what's going on with the markets. Another very strong day. We're trading right at record highs. 65.85 on the S&P 500. This is the index that we check each week. It's not the only index that a trader might check. But let's just say that our hypothetical trader is planning to add to their portfolio. Maybe they're looking out past this September 19th expiration. We already have some contracts expiring then. So how about we go out, let's go do a bullish trade. Let's say that our trader thinks that stocks are just more likely to rise than to fall between now and October 17th expiration. So I'm going to go do a long call vertical spread. And the example stock that we're going to be doing that on today is NVIDIA. Why did we choose NVIDIA? Well, for some traders, they look at price per share. Because when we're dealing with contracts, we're entering into potential scenarios where we might exchange shares of the stock. So highly expensive stocks can lead to expensive scenarios like that. Lower price stocks may just not have very many options to choose from. I'm going to look at one that's in sort of the mid-range triple digits. Stock's $178. Another consideration might be liquidity. If a stock is illiquid, its options tend to be highly illiquid, and it can make it harder to get into and out of those efficiently. All right, now there can be obviously other considerations. Maybe it's in a sector the trader prefers. Maybe the company is doing something fundamentally that the trader likes. But another thing that the trader might consider is what's going on with the chart. And what some might note with NVIDIA is that it's been using about that 165 level as a price floor now for about 2 months. And let's just say that our trader thinks that is likely to continue to act as a floor. And even if the stock pulls down, maybe it'll ricochet off that floor or possibly go higher. In any case, looking for the stock to stay above 165. Let's do a bullish spread at 165. And how about we buy the 160, which is going to position this trade right down below that support. Let's buy the 160 call, sell the 165 call, creating a bullish vertical spread that's in position to hit its optimal outcome if the stock is above 165. Isaiah says you learned a lot from this diagonal class, especially about the deep in the money options and selling short term. Hey, my pleasure, Isaiah. Thank you. Yeah. So here's going to be our example trade. Let's go to the trade tab. Let's go out here to the 17th of October and moving down to the 160, 165 strike pair. Let's see how much that would cost us. I'm going to switch this up from single to vertical. 160, 165. Looks like it costs us maybe 80. Pardon me. I'm looking. This is just force of habit. Sometimes when you've been talking about credit spreads, you look over on the credit side of things. I need to go over the debit side of things. So the 160, 165 call spread. Here, Cameron. Hey, here's your heads up. The calls are on the left, as they've always been for the 20 years that I've been doing this. Anyway, it looks like that might cost us around, I don't know, $4.10, $4.15, somewhere between $3.95 and $4.25. The midpoint is going to be right around $4.10 at this moment. So if we spend $4.10 to buy into a $5 wide spread, how much does that leave for reward? It's about 90 cents. So our $4.10 investment could grow to $5. So over a 20% potential return there. And if the stock just stays where it is, if it goes higher, even if it comes lower, we're in position to make that. So here's where we'd like this trade to be as we move toward expiration. This is our sweet spot up here, above 165. Falling below 160 is where we don't want this to go. Let's make this red. This is where we prefer not to go. All right, let's go place that trade. 160, 165. I'm going to click on the ask price. And that's in my portfolio right now, it's set to buy 10 contracts. We tend to try to keep the investment in these trades or the maximum loss in these trades at about $4,000, which is actually right where this would be. It'd be a little bit over $4,000 at 10 contracts, or about, let's see, that mid. We might have to spend a little bit more here. Let's crank this up to 420. That'd be a $4,200 investment. I'm going to dial this down to just 9 contracts. $420 per contract times 9. It's going to have us, what, about $3,800 at this point. Let's see, Jerry says, why not closer to the trading price and get more profit? Jerry, we could, right? So I've chosen some example strikes, not the only strikes we could have chosen. The trader can be more aggressive and buy some higher strikes, which requires the stock to be higher at expiration, but it'll also deliver higher potential reward. That's a lower probability, higher reward scenario. Trader also could have gone lower with their strikes, further away from the stock, so the stock gives more wiggle room. That's a higher probability scenario, but it's going to have lower associated reward potential. So the trader, one of the things that some traders really like about vertical spreads is that they are highly customizable to a trader's preference. We can be more aggressive, low probability, high reward, or the trader can be more conservative, lower reward, higher probability. Noodlebrain says, why do you choose that method over selling a vertical put for 84 cents? So Noodlebrain is a good question. Number one, this webcast series never talks about credit spreads. This one's literally called long verticals. So I'm just never going to do credit spreads in this webcast series. It's not to say there's anything wrong with them. And as a matter of fact, before we place this trade, let me make this suggestion. I actually did a video weighing the pros and the cons of credit versus debit spreads. So if you go to our YouTube channel, so again, subscribe, but go to the channel and click on the little search box here, just type in credit, debit. I have a typo in there. Let's get rid of this F. There we go. And just hit enter on our keyboard. Here's an options vertical showdown. Trade a credit or a debit spread. Check out that webcast. I'm going to throw out a spoiler alert that might surprise some of you and just skip to the end and say, there's almost no difference between the two. I think a lot of people say, you are crazy, Cameron. There's a huge difference between getting a credit and a debit. Nope, not really. Go check that out. You'll see why. Anyway, let's go back to our trade. And let's place this thing. Looks like we're still right in between the mid and the natural. Let me open this up. Yeah, I think that's okay. Let's put this back at 420. And let's click confirm and send. So we're going to buy 9, we're trying to buy 9 vertical spreads, the 160, 165 call spread for a maximum of 420. If we're able to do that, That gives us a maximum profit of $720. It gives us a maximum loss of $37.80 across those 9 contracts. There are commissions to be paid here. Let's send that off. So let's see if that's working toward fill. Yeah, we're offering to pay $420. Right now, the market value is only about $412. So I expected this to fill fairly quickly, and it did. Bought that for $415. So we've just made a $415 investment. If the stock goes up, that's what we'd like to see happen, because we have the right to buy shares at 160. If they're subsequently sold at 165, if both of these contract, if we exercise at 160 and we are assigned at 165, buying the shares at 160, selling the shares at 165, that'd be a $5 profit, except we've spent $4.20 to set this deal up. That would leave us with our 80-cent maximum gain per share. If the stock collapses, let's say we're down at 150, we don't exercise. We just let our contract expire worthless. The other the trader who has the right to buy shares from us for 165 probably don't want them if they're only 150. That expires worthless, and the $4.20 that we spent is lost. Now, obviously, we might decide to do something with this vertical spread between now and expiration, but I'm just talking through what possible scenarios are at expiration. And finally, if we wind up in between our strikes and we allow this to get to expiration, we buy the shares at 160. They're probably not purchased from us for 165. And we just wind up owning the shares. So those are some of the potential outcomes. I went through those kind of quickly because I wanted to spend more time on the discussion of this early assignment. It can be spooky. But guys, we've done what I wanted to do today. We took the opportunity to talk through what are some of the factors that can raise the risk of early assignment. And if that really spooky thing happens, if we are assigned, what might the trader do to handle that from that point? Hope that was a good discussion for you. We're going to follow up on this trade and our other trades next week. So I hope you'll join me again next week, or just watch that video from next week. I also am very active on X. So Brent and I would love to have you there as followers on X. So a couple of suggestions if you're trying to optimize your educational offerings from Schwab. It extends way beyond just these live streams. First of all, make sure that you're subscribed to our Trader Talks channel. It doesn't cost anything to do that. It only takes a second. You go down that lower right-hand corner, click on subscribe, and then you can find our playlists on that channel homepage. Go to playlist right here. You can join the live streams right there. And also, as you've noted, as I've demonstrated, you can just do keyword searches for topics of particular interest, and it'll filter through all of our playlists and just grab those videos that are related. Also, follow your favorite presenters on X. If you have an account there, give us a follow. You can find Brent on X at Brent Moore CS. You can find me on X at Cameron May CS. If you reply to one of my posts there, I try to reply right back to you. So like recently, I pointed this out that NBIS popped up more than 50% in one day on a massive deal that it just made with Microsoft. So I asked my followers, do you see this as an opportunity to buy on a stock with strong momentum, or is it more of a, hey, hit the brakes, hit the pause button, wait to see if a little bit of those profits are taken before entry, if that entry is ever made? So I just like to get people's input here, and we can have sort of a back and forth about this sort of thing. But great place to connect with your favorite presenters there. Time for me to let you go, guys. Thank you, Sia, for the reminder to click the thumbs up. I can see 151 people watching. There are about 57 have already clicked that like button. If you enjoy one of our webcasts, make a habit, just click the like button before closing out, because it's like applause to your presenter. It also gives a boost to that presenter's webcast, and YouTube algorithm helps more people find these webcasts and learn about things like, oh, what can elevate the risk of early assignment, and what are some considerations if early assignment happens? That's a big question. All right, everybody, Go have a great day. I will see you next Thursday. I'll see you in one of my other webcasts in between now and then. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.